Good afternoon, everybody, and welcome to this edition of our weekly Broker Moves Review for week ending Friday, 30th of April. A little bit belated, sorry, so much information to collate for this one. I just couldn't quite squeeze it in before close of business on Friday, but the good news is it's all here for you today after we talk about the Think Markets difference, which is substantial. $8 flat rate trades, your own holder identification number, unlimited phone support, and of course, no hidden platform or subscription fees. 4 fantastic reasons why your next ASX share trade should be with Think Markets. And if you'd like to join the Think Markets family, by June 30, we'll have the first 5 trades there waiting for you as well. There are some terms and conditions, so please head to the website for further details. The agenda for today is to check out all the ratings, upgrades and downgrades, price target increases and decreases for ASX stocks over the last week or so, and then check out a few stocks of interest. Kicking off first up with the broker upgrades. Now, each broker has a rating systems for the stocks that they cover, anywhere from a buy down to a hold, which is obviously fairly neutral on the stock, down to a sell, which means get rid of it. And there are a few ratings in between, as we can see on screen. And they also have a price target based upon their valuation for the stock, essentially where they think the stock could be in sort of 12 to 18 months' time. So looking at the first one on screen, Macquarie Bank on the technology company Appen, ticker code APX. Their rating went from underperform, which is kind of like a sell, but maybe not as strong, to neutral, and their price target was unchanged at $16. Now, they think the stock is fairly fully valued because there's only 0.9% between the current price and their target price. Now, Macquarie on Appen said that the 33% decline in the company's share price over the last 3 months had improved the risk reward in terms of the valuation. The broker has warned the market previously of the risk of increased competition in that industry, and that potentially that competition could lead to downgrades, so maybe the broker giving themselves a pat on the back in terms of those falls, but happy to go back to neutral. Looking down the list there, Coles Group reported their third quarter sales, supermarket sales well below expectations in the March quarter, with comparable sales down 6.4%, but on a positive note, their online sales jumped 49%. Now, in that upgrade there from neutral to buy, Citigroup said that Coles has potentially reached an inflection point around their market share and sales differentials, and the worst in terms of their recent underperformance is potentially behind the company. They said that sales growth going forward would be improving, potentially as the COVID sort of washes through the system, or the impact of COVID washes through the system, and also assisted by falling costs also. Now, note that their price target actually went down here from $19 to $18. That's a 5.3% decrease in that target, but the broker is still seeing about 10.3% from where the share price is to that $18 target price. Credit Suisse going from neutral to outperform. They decreased their price target also, and about 10% again seen to the upside there. Looking at JB Hi-Fi, Credit Suisse said that the March quarter trading result that they had out during the week was surprisingly strong, and that the market is potentially underestimating the sales growth momentum that still exists in that segment of the retail market. So, obviously electrical goods and home wares. Credit Suisse, in their broker note, upgraded their FY21 estimates on the basis of those strong results, and also they increased their expectations for the final quarter of 2021 as well. Oil Search, UBS, one of the few brokers that saw the bright side of their first quarter production, which is down 2.7% from the previous quarter and nearly 7% from the prior corresponding period a year ago. Management advised that production was impacted by an unplanned shutdown at their Hides operation, but fortunately, due to very, very strong energy prices, revenues overall were 16% higher. Production guidance for FY21, importantly, was maintained. Another positive is that its investment expenditure guidance has been reduced by between $75 and $95 million US, and that's been driven by cost savings through the business. Also remaining unchanged was its unit production cost guidance of 1050 to 1150 barrels of oil equivalent, but other operating costs unfortunately were expected to increase by as much as $20 US more than initially expected. As we said, there were some brokers not so happy with that one. We'll talk about them later, but for now, UBS going from neutral to buy. Price target coming down by 2.2%, however, but still 16.6% to the good potentially in that one. Resolute Mining, they had a quarterly production report out, and Macquarie noted that their production was about 11% below the broker's expectations, whilst costs were about 8% higher. So when production's lower and costs are higher, you've got a double whammy negative impact to the bottom line. Didn't stop Macquarie, however, increasing their rating from neutral to outperform, no change to the price target, still about 20% seen at that one. On Zimbabwe Mining, they had a bit of a disaster of a March quarter report. Gold production at about 82,000 ounces, missed Citigroup's expectations by about 19%, while costs were higher by about 17% more than expected. Again, the double whammy there. Production at Zimbabwe fell to a 5-year low. Costs shot up. Zimbabwe has fallen a hell of a lot in its share price, and Citigroup said that that's basically the reason why they're seeing some value there. So they went from neutral to buy, and the price target actually increased, funnily enough, despite all of those horrible things, from 230 to 240, and there's plenty of upside in it seen at Citigroup, but we will see some negative broker reviews on that one a little later on. On Australia, New Zealand Group, Citigroup went from buy to neutral, just saying that the stock has had a really good run in prices, and in anticipation of its half-yearly reports, they felt they'll go back to neutral. They did increase the price target nicely, though, from 26.50 to 30.25, so that's a positive if you're holding ANZ shares, but it's fairly fully valued there with only 5% left of the upside. That was the theme for BlueScope Steel, both Credit Suisse and Macquarie saying that the stock is fairly valued at this point, hence the downgrades from outperform to neutral. There was a price target increase there, very small one at Macquarie, and they are still seeing about 11% upside in the stock. Sealink Travel going down from outperform to neutral, and Accent Group from buy to neutral, but still raising the price target by 8.8%. Having a look at the price target increases, so no change in the ratings here. Ansell got 4, that's one of our stocks of interest today. Fairly modest price target increases and reasonable upside seen there from 3 out of the 4 brokers, with really only Macquarie saying that the stock is fully valued here. A few there from ANZ, similar reasons I discussed earlier. Accent Group, we've talked about that one. BlueScope Steel we'll also discussed, so we'll continue down the list into Downer Group. They had an investor day. They announced a 10% share buyback, which was very well received by brokers, hence the 3 increases in their price target. Fair bit of upside there, I think, from Credit Suisse and Morgan Stanley. That's nice, and their outperform on whole and overweight respectively. Morgan Stanley and JP Morgan saying that it could just be the start of these types of returns to shareholders. Dexus Group getting a couple there, JP Morgan and Macquarie looking down the list. IGO and Aluka Resources getting a couple each, not huge, so we'll keep moving. We are in March quarterly reporting season, and both of those companies have had some updates out recently, as did Mirvac Group, but not huge updates. So let's try and find the bigger and more interesting ones. Well, NHF, there's 6 in a row there, so worth discussing that. The company provided their March quarter update. They said that their Australian health insurance business has been performing well, and that's offsetting weakness in its international operations. In light of this, they tabled a $140 million underlying profit for the first 9 months of the 2021 financial year. They now expect their full year profit to come in between $225 million for the full year, and previously they hadn't provided any guidance. So now that they have guidance, the brokers have to go through, recheck the numbers, and as a result of that, updates will flow, and we can see generally fairly modest price target increases there, perhaps Credit Suisse with the biggest one, but they are clearly seeing that the stock is fully valued here with a neutral recommendation. Let's keep moving through the list. As you can see, plenty to get through. RWC, they also reported their trading update. They said that group sales were up 14% to $359 million. Growth was experienced across all of the regions they operate in, with the Americas up 39%, boosted by that big Texas freeze event. You might be thinking, what the hell's going on there? 39% increase in sales. Well, these guys do basically plumbing supplies, water control system plumbing solutions. So when things freeze over, pipes burst and they need to be replaced. So good news for WC shareholders, some modest price target increases there. Plenty of upside seen from JP Morgan with them also going for a buy on the stock. South 32 had a trading update. Lead and zinc production at their Cannington mine was better than expected on the back of higher ore grades, but alumina production at Worsley was down 7% and coal was also disappointing, with production down 24% amid sluggish demand conditions and production disruptions. Nonetheless, we saw 4 out of 4 price target increases there and a fair bit of upside seen across those brokers with unanimous buys on the stock, so that's impressive. Looking down the list again, Steadfast, they are a big insurance broker. They had a very short and sweet announcement with very few details apart from the numbers, and that's what I like. They said for the 9 months to the end of March, they'd seen a 20% increase in EBITDA on a 7.2% increase in revenue. Looking forward, they upgraded their FY21 net profit guidance range from 120 to 127 million to 127 million to 132. Well received by the brokers, 3 out of 3 price target increases there, and still quite a bit of upside seen at all 3 brokers with outperform, accumulate, outperform quite positive as well. Sandfire Resources, March quarter production, they said they're on track to achieve the top end of their previously provided FY21 guidance of 67 to 70,000 tonnes of copper. Gold production was 80% of the full year guidance already of the guidance range of 36 to 40,000 ounces. And management also lowered their cost guidance by around 6%. So production firing on all cylinders and costs coming down. That is a positive for Sandfire Resources, and Morgan Stanley reacting accordingly with a 29.3% increase in its price target. Still some upside seen there. Also at Macquarie, but Citigroup and JP Morgan thinking that it is fully valued. Having a look into the final page, I'll let you press pause and read the rest of those. And that is the theme for Broker Moves. As always, press pause and see if your stock is on screen. We've talked about many of these already. Fortescue had a quarterly production report largely in line with expectations. Production of iron ore up 7% on the previous quarter, very impressive, but shipments were down 9%. A couple of operational issues there to blame. Also, shipping pretty tight at the moment. Year on year, though, shipments were up 2%, so that's still pretty good. Costs, unfortunately, I think costs were the reason why brokers downgraded here. So their costs increased by about 16% to US $14.90 a wet metric tonne, and CapEx guidance went up by about 10% due to a further escalation of issues at the Iron Bridge project. Now, that was where they had a prior cost blowout announced earlier in the year. So fairly modest declines there, and a mixed review on terms of what's left in it. So JP Morgan's still very bullish, but Morgan Stanley very bearish, and it's hard to get any consensus when you've got stats like that. We have talked about All Search already, so we'll keep moving. Zimbabwe Mines was that shocking quarterly production update. Woolworths also had some quarterly numbers out. We mentioned Ansell earlier on, a very, very strong performance from them, and the share price reacting accordingly. I'll let you press pause and read what the brokers had to say. Overall, we do have 2 strong buys, 4 buys, 4 holds. No sells, no strong sells. That's encouraging. Looking at the numbers, very reasonable on an enterprise value to revenue basis. Looking at the PE, I wouldn't say that's cheap, but there's enough growth in there from the PE growth ratio for me to want to back this one. Dividend yield is modest. Not bad. Price to cash flow looks very good. Return on equity is excellent. And as a result, overall, I think I would give that a very solid B+. That's a big tick there. The chart looks fantastic. So 3 ticks from me on Ansell. Having a look at NHF ticker code, which is NIB Holdings. As I said, they reported a trading update there and reinstated their profit guidance range. Brokers generally positive on that. I'll let you press pause and read the comments. In terms of the consensus, not as good as Ansell. We do have 2 buys, but with 8 holds and 1 sell, we're generally stuck in the middle there. I should mention, I'll just go back one slide and talk about the mean price target, because that's the average price target from the brokers at 44.47. Probably will get ratcheted a little higher because it does take this data provider a little time to update these moves. Okay, so there is still some upside seen in the Ansell price. Back to NIB, the mean target there is 5.98, and it again will move a little higher, but it does show that the stock is fairly fully valued. So we're seeing the impact of how much the brokers think is left in these companies in terms of their valuation, reflecting back on those ratings. Looking at the fundamentals, look, that's very strong there, the EV to revenue number. The PE, once again, not cheap and not enough growth in the business to suggest that that's going to improve. That's a concern for me. The dividend yield is quite solid, however, and the return on equity is excellent. I'm probably at a B here. I'm disappointed by the growth in the business. This is not fantastic, but the chart does look very, very constructive here. So I'm happy to give that one a tick. Potentially you could buy it on a pullback and then potentially a move through this resistance zone. So let's go tick, tick, cross. Let you make of that what you will. In terms of Reliance worldwide, we discussed that they are a rather lucky beneficiary of some very bad weather in Texas. Brokers increasing their price target. That mean target at the moment is about $5, which would indicate that it's fairly fully valued. Of course, with the updates, it will go a little higher, but that fully valued idea is reflected in the broker ratings with 5 buys, 4 holds, and the 1 sell. Just edging it, I would think, into neutral. In terms of the fundamentals, still pretty good here on enterprise value to revenue. The PE is not cheap, but there is some growth in the business, so that is encouraging. Dividend yield fairly modest. Return on equity is not bad, not great. That's probably a solid B there as well. I'm going to cross that one and go tick, tick here. That looks pretty good. Again, you might be looking for pullbacks, 2 out of 3 on Reliance worldwide. Heading into Zimbabwe Mines, I think we're going to have a few crosses popping up here. Well, certainly I'm giving this one a cross because the short-term trend is down, the long-term trend is down, the candles are predominantly black, and we have broken through some key technical support zones. Might get saved by $1.60, and the fact that the fundamentals probably look pretty good, I'm guessing, given it's down here now, so obviously it improves the valuation as the share price falls, all things being equal, assuming it can continue to perform on the financial side of things. But EV to revenue looks very cheap, and the brokers are expecting it to get better. The PE ratio is very, very low. I mean, it's quote unquote the cheapest stock we've seen out of all of the ones we've reviewed today. The PE growth ratio looks fantastic, and that is forcing that PE even lower into FY22. Dividend yield is very solid as well. The return on equity is modest, but expected to improve. Looking at that, I'd almost give this an A. So that's a big tick there. This is a tick. The brokers are keeping the faith on it, but I'm across here. So what does that mean? That means, well, we need a signal. We need a technical signal to buy. We're not there yet. It might look like something like this. You know, it might be a move back above the long-term downtrend zone. So very interesting setup here. You know, looking at it from a top-down point of view, but we need to see some improvement on the technicals. We want to see that the market agrees with our assessment. And our final stock in focus today is Sandfire Resources. Obviously, their quarterly report well received by brokers ahead of schedule and flagging reduced costs. Brokers quite positive towards this one, so 2 strong buys. That's a strong buy. 5 buys, 6 holds. No sells, no strong sells. I do like to see that because it means, beauty is always in the eye of the beholder, but nobody's beholding this in a negative way. Having a look at the mean target here, 688. It's going to go up with some of these price target increases, but maybe suggesting it's fully valued. Having a look at the fundamentals, quite constructive here on enterprise value to revenue. That is excellent. The PE is outstanding. I mean, this is ridiculously cheap, and with the growth that's in the business, it's going to stay that way. The dividend yield is excellent. Price to free cash flow is excellent. These numbers are outstanding. So this is an A+ here, flat out. And this is a major tick, and the chart looks fantastic as well. So make of that what you will. Would I buy it right now? No, I think I'm prepared to wait for a little pullback, probably into this 640 zone. Pick it back in here, and then happy to lock that one away. I think it all checks out as far as I'm concerned. Press pause and read what the brokers have to say about it. Well, that's it for me today. We got there in the end, I think, with Sandfire Resources. Certainly one to take a closer look at. You can check up on all of our other market news updates in the market news section of the website. You can follow me, all the Think Market handles there on Twitter. Head to the website, also to our webinar section, and register for our upcoming webinars. Tomorrow we'll be doing a fundamental analysis refresher. Now, if you're wondering what the hell it is I was talking about there with enterprise value to revenue, all of those fandangled things, I'll explain it to you tomorrow. Catch up with me next Tuesday and bring your portfolio along, and I'll give you a quick fundamental and technical on the stocks you're interested in. And then on the 18th of May, we'll continue with our 3 series of webinars, 3 ASX stocks under 30 cents. The disclaimer before I leave you today says that everything we've discussed is general advice. We are a regulated Australian broker. We do have some products that could see you lose more than your deposit, so make sure you read this disclaimer carefully or give us a call if you have any questions at all. It's been a pleasure chatting with you today. All the best for your trading. Until we catch up again. Bye-bye for now.